Hello, today I'll be talking about one of my largest holdings in my portfolio, a company that is facing some sort of existential threat, as well as why I'm still holding on to the business. So before I go into the business, let's talk about some high quality compounders first. So some metrics for high quality compounders include a monopoly or a duopoly structure. You want companies with operating leverage where the profit margins are increasing over time. You want companies with organic growth. You want companies that are capital light, as well as having good management that does buybacks, dividends, and basically stops doing all different types of acquisitions and defensive acquisitions. So let's talk about the stock that I've been holding for a while right now and why I'm still overall bullish on this business. So this stock is none other than Google. So Google over here is a business that has been sold off by all your different super investors. If you were to look at Q4, for example, there's been a net selling of Google, same in Q3, same in Q2 as well. So it's been like that for a while already. And why exactly are all these different super investors selling Google today? So let's talk about Google's fundamentals first. So Google over here is a company that's trading at 19 times earnings, a 17 times forward earnings. And if you're to just look at the S&P 500, for example, so the S&P 500 PE is currently now at a 25 times. So you have a company, Google, that's trading at 19 times earnings, whereas the S&P 500 is trading at around 25 times earnings. So Google is around 20% or 30% cheaper than the overall market. And overall, I think it is not justifiable for a business like Google, a top 10 business in the entire world, to trade so much cheaper as compared to the markets in general. So either the markets are extremely overvalued or Google is extremely cheap. So for Google's fundamentals over here, we were talking about some metrics to look out for all your different quality compounders. So one of them is you want them to have organic revenue growth. So for Google over here, it is a company that certainly has organic revenue growth. You have revenue growth of 13% every single year. Basically 10 to 13% every single year. You have net income growth last year of around 35%, and then EPS growth of around 38%. This is clearly not a business that is showing weakness in terms of its fundamentals. It is a company that is trading relatively strong. It is still a company that is showing very strong fundamentals in all its different parts over here. And then you have this portion over here, which is Google's profit margin. As you can see, Google's profit margin has been increasing over time as well. Currently, it's around a 28% net profit margin, 58% gross margin. So overall, this is clearly a company that is showing some form of operating leverage because they can increase their profit margins over time. And whenever you talk about quality compounders, you want compounders that can increase their profit margin over time because this clearly shows that they have operating leverage. They're able to raise prices and basically just dominate the industry that they're in. So this is Google's revenue by segment. Yeah, as you can see, the fundamentals are showing that this company is still an extremely high quality one. And if you're to just look at some of its portions over here, so for example, Google Cloud is growing at 30.6%. It grew 30.6% in Q1 of this year. And you have Google YouTube as well. Google YouTube is also growing at around 14% every single year. And I think Google YouTube is an extremely underrated business in the entire Google ecosystem. And then you have Google Search as well. Google Search grew around 13% last year. I don't expect them to grow at such a high rate, but you've seen over here that there's never been a negative year of growth ever since ChatGPT came out. And so again, the fundamentals are showing that this is an extremely healthy business that is going to dominate the next few years or so. So over here, Google search grew 20% in 2024, receives 373 more searches than ChatGPT. So ChatGPT is still a relatively small competitor in terms of search, in terms of the search market share as compared to Google. Google is still the giant in this search industry. So my bull thesis for Google is that Google will be able to diversify all the different revenue streams out of search. So you have Google Cloud, for example, Google YouTube, and then Google subscription as well. All those different revenue streams will start to increase over time, and then Google will be able to sort of like be less reliant on search because search is it's a business that could face threat, obviously. So let's talk about my bear cases for Google over here. So Google, they recently just made an acquisition. They are planning to buy another company, a cybersecurity company called Wiz, for around $32 billion. I hate this acquisition. So why do I hate this acquisition? Because if you have to look into the numbers for Google, Google is buying Wiz for 32 billion. The operating cash flow now is around 125 billion. So let's say the operating cash flow grows by 10% to around 137.5 billion. You have capex at 75 billion that they are basically reassuring to shareholders again. They are reassuring that they're spending around 75 billion this year. And then you have stock-based comp at around 22 billion. That leaves them with around a 40.5 billion in terms of free cash flow. You spend around 32 billion on the Wiz acquisition. That leaves around 8 billion in terms of buybacks. And for a company that is trading at such a low valuation, around a 19 times earnings today, there is no reason for them to basically not do any buybacks. In fact, they should be doubling down on buybacks at current prices because the stock price is so cheap, and I don't think the timing of the Wiz acquisition was right. Next, bear thesis over here. So for Google search paid click change, Google search paid click increase has been slowing over time. So this is in 2022 to 2023. This is the 2023 annual report. As you can see, the paid click increased by about 7%. And then in 2024, it decelerated to around 5%. So you can clearly see some form of deceleration in terms of the business. And then you have your Google network as well. Your Google network impression changes has dropped by around 11% in 2024, and it dropped by around 5% in 2023. So yeah, there could be an argument made that Google is decelerating, the Google search platform is decelerating in terms of growth, but there's also another side of the story that you can say, which is that Google has extreme pricing power, because Google, the cost per click was around a 1% increase in 2023, and in 2024, the cost per click went up by around 7%. So this clearly shows that there is some form of pricing power there. Google is increasing their prices to offset their volume. But over time, this is not sustainable. This is definitely not a sustainable sort of way to increase your revenue over time, as we are seeing now with another company called Adobe. Next portion. So this is your app store ranking over here. So ChatGPT is currently at the top, and then you have Google, which is fourth place. So Google may be facing some sort of threat from all your different LLMs, and your LLMs are increasing in terms of efficiency, in terms of their capabilities over time. It will be exponential, and if more people start using the LLMs, then there could be less searches on Google. So this is Grok, for example. So Grok is incredible. So if you're to key in something like this on Grok, for example, is Google stock a buy today, you will immediately get a response. So this is the response by Grok over here. So you can clearly see that this LLMs, they're getting more and more capable, they're getting more and more reliable, and they can come up with analysis like this within seconds or so. But if you were to just do the same exact thing, if you were to search for the same exact thing on Google, you will get a much less sophisticated response. You'll get a response that links you to all your different web pages and so on. And so yeah, you can clearly see your LLMs are getting stronger, and I do think that there is some sort of bear case in terms of your LLMs taking over Google's market share. Next portion over here is Google's capex. So this is the capex of all your different Mac 7 stocks. They're projected to be at around, I think, 200 billion in 2025. And Google is contributing around 75 billion to all that different capex. So if this capex doesn't pay off, it will lead to a lot of depreciation for all your different businesses. And if those depreciation come in, then we could see the earnings taking a hit in the future. So currently, the free cash flow is taking a hit. And then in the next few years or so, when the depreciation starts to come in, then the earnings will definitely start to take a hit if there's no return on investment on all this different capex spending. But currently, we're still seeing that return on investment. So this is Google's ROIC over here, the return on invested capital. Return on invested capital has been growing up and up and up over the past few years or so. And so it is still justifiable for them to have such a high capex. But if those returns slow down or if those returns don't come in, then this could definitely hurt the stock. So for Google over here, I do think that LLMs will overlap with search, but not take over search, because search is made up of a lot of all your different consumer searches. So for example, searches for your restaurant, searches for maybe travel and all that. And whereas for your LLMs, they are more for research purposes. Google's other revenue streams are also growing extremely quickly. So you have Google Search growing at around 30%, you have YouTube growing at 14%, you have other bets like Waymo as well, which are part of Google as well, which is not accounted in terms of its valuation. So if you're to just look at the grand scheme of things over here, this is my summary. It is true that Google's core business is sort of like under attack by LLMs, because they could easily be taken away by LLMs in the next few years if LLMs start to increase their capabilities and all your different suites. But for a business that is a top 10 business in the entire world, trading at a 19 times earnings, I do think the valuation makes sense right now for you to invest into Google. And my fair value for Google is at around between $180 to $200. So there's around a 15 to 20% margin of safety over there. Last portion, business quality is still up there, and unless the numbers show, I'm still holding this stock. So currently I own around 12% of my entire portfolio in Google. I've been holding this for a while, and I've been adding all the way down, all the way until $139 recently. So overall for Google over here, I don't think it is a company that is a sell today. In fact, I think it is a company that is a buy today, simply because the valuation is extremely cheap, the risk to reward is there, and when you have a Max 7 company, a quality business trading at 19 times earnings, it is definitely a buy today. So yeah, there's another super investor that I look up to as well. His name is Li Lu. So this is Li Lu's portfolio. Let's take a look. For Li Lu, I think he added in Q1 of this year. So Li Lu has around 38% of his position in Google, and he hasn't sold Google in like, I think, in a while already. So the last time he bought Google was in Q4 2022. Hasn't sold a single share despite of all this LLM. So yeah, if Lilu is not selling it, then yeah, I don't think there is very much of an argument for you to sell Google today. In fact, I think Google is still a buy today. Hopefully you guys have found this one useful, and unless Google starts to show fundamental shifts or starts to show some form of fundamental weakness, I won't be selling the stock. So invest safe.